Thursday in August is the way to look at it. It's a mixed open. We've been a very narrow trading range the last couple days. Take a look at the sectors. We got energy, modest move up at the open in techs. Banks down a little bit at the open. There was some weakness in the 10-year yield as the PPI numbers are a little weaker than expected. Banks are positive now. Industrial's up. Semis were downgraded by Morgan Stanley, and they're trading to the downside, as you can see. It is the second week of August, as you heard there, but the markets are very tightly wound. Just take a look at where we're at. The positioning is a little lopsided in a lot of the sectors. So we're essentially, let's not quibble, at record highs on the markets, on the stock market. Volatility, we're near the lows for the year on the VIX. In fact, the whole VIX curve has been flattening recently. Treasuries, a lot of shorts out in treasuries right now. And the dollar, there's a lot of bulls out there. So there's a lot of lopsided positioning. My point is that it seems a little boring at the moment, but this could move very, very quickly if we get some events. As for where we are, I have been saying the United States is the place to be for a very simple reason. It's the earnings picture. I just want to show you the global earnings situation for the second quarter. 24% growth in the U.S. for earnings versus 10% in Europe, 9% in Japan. You say, well, it's the tax cuts. About a third of it is tax cuts. So take out the tax cuts, U.S. earnings growth would be about 15%. Still much better than Europe, still much better than Japan without the tax cuts. The revenue picture is the same. It's improved all over the world, but the U.S., far and away the better number here because we've got 9% growth in the United States for revenues. We've got 4% over in Europe. These are revenues, put up the revenue numbers, and 6%, up 6% overall for Japan. Those are second quarter revenue numbers, as you can see there. Okay, so the important thing is what's moving the markets is the U.S. is the place to be, and that's why our markets have been outperforming the rest of the world here. So we've got that strong earnings story, we've got the GDP growth, we've got the tidal wave of buybacks and dividends, unlimited tariff impact, and we've had the sector rotation that's been going on. So as something falls down, like tech had end of last month, they don't sell out and get away from the markets. They go in and buy other things. We've seen that rotation into value. That has largely played out. So if you look at the trading patterns in the last 5 days, tech has made a modest comeback. So some of the big names, your Microsoft, Lam Research, Alphabet, Intel, in the last week, they had sold off into the end of July and the beginning of August. They're now marginally higher. The sector that had done really well, consumer staples, became a sort of proxy for value stocks that had all risen at the end of July and the beginning of August. Generally, they're down. Generally, Kimberly-Clark, General Mills, these are the ones that had the big run-ups towards the end of the drive. So what we're seeing here is a rotation back into the old leadership group of technology with no dramatic drops in the consumer staples. They're sort of now sideways after having risen rather dramatically, up about 10% since the month of June. It's that sector rotation that keeps the market so strong. Right now, the Dow is flat, down 7 points. Carl, back to you.